Like budgeting, responsibility accounting is an important part of management accounting. Responsibility accounting involves accumulating and reporting cost and revenues when relevant on the basis of the manager who has the authority to make the day-to-day decisions about that item. Responsibility accounting gives managers responsibility for controllable cost at each level of authority. You can see here in this image that the department manager will be responsible for controlling the cost in his department, whereas the division manager, she will be responsible for controlling the cost in her division, and then the company president will be responsible for controlling all the cost. Under responsibility accounting, any individual who controls a specified set of activities can be a responsibility center. Responsibility accounting may extend from the lowest levels to the top levels of management. Responsibility accounting is especially valuable in a decentralized company. Decentralization means that the control of operations is delegated to many managers throughout the organization. The term segment is sometimes used to identify an area of responsibility in a decentralized operation. Under responsibility accounting, companies prepare segment reports periodically, such as monthly, quarterly, and annually, to evaluate managers' performance. Responsibility accounting is an essential part of any effective system of budgetary control. The reporting of cost and revenues under responsibility accounting differs from budgeting in two respects. The first, a distinction is made between controllable and non-controllable items. The second is performance reports either emphasize or include only items controllable by the individual manager. All companies use responsibility accounting. Without some form of responsibility accounting, there would be chaos in discharging management's control function. All costs and revenues are controllable at some level of responsibility within a company. Under responsibility accounting, the critical issue is whether the cost or revenue is controllable at the level of responsibility with which it is associated. A cost which a manager has control is called a controllable cost. In contrast, costs incurred indirectly and allocated to a responsibility level are non-controllable costs. Management by exception means that top management's review of a budget report is focused either entirely or primarily on the differences between the actual results and the planned objective. This approach enables top management to focus on problem areas. Management by exception does not mean that top management will investigate every difference. For this approach to be effective, there must be guidelines for identifying an exception. The usual criteria are materiality and controllability. Without quantitative guidelines, management would have to investigate every budget difference regardless of the amount. Materiality is usually expressed as a percentage difference from the budget. For example, management may set this percentage difference at 5% for important items and 10% for other items. Managers will investigate all differences either over or under budget by the specified percentage. Cost over budget warrant investigation to determine why they were not controlled. Likewise, cost under budget merit investigation to determine whether costs critical to profitability are being curtailed. For example, if a maintenance costs are budgeted $80,000, but only $40,000 is spent, major unexpected breakdowns in productive facilities may occur in the future. Another approach is a company may specify a single percentage difference from budget for all items and supplement this guidelines with a minimum dollar limit. For example, the exception criteria may be stated at 5% of budget or more than $10,000. Managers will investigate all differences either over or under budget by $10,000. Exception guidelines are more restrictive for controllable items than for items the manager cannot control. In fact, there may be no guidelines for controllable items. For example, a large unfavorable difference between actual and budgeted property tax expense may not be flagged for investigation because the only possible cause are unexpected increase in the tax rate or the assessed value of the property. An investigation into that difference would be useless. The manager cannot control either cause. A responsibility reporting system involves the preparation of a report for each level of responsibility in the company's organizational chart. It begins with the lowest level of responsibility and moves upward to higher levels. It permits management by exception at each level of responsibility. Each higher level can obtain the detailed report for each lower level. To illustrate this system, we use this partial organizational chart. The responsibility reporting system begins with the lowest level of responsibility for controlling costs and moves upward to each higher level. So if we start down at the lower level, we have department managers that are going to be responsible for controlling costs within his or her department. If you go up to the next level, the plant managers will see the summary of controllable cost for each department in the plant. If you go up the next level, right, vice president, specifically the vice president of production, will see a summary of controllable cost for each plant. And then finally, at the highest level, the president will see a summary data for all of his or her VPs. There are three basic types of responsibility centers: cost centers, profit centers, and investment centers. These classifications indicate the degree of responsibility the manager has for the performance of the center. A cost center incurs cost and expenses, but does not directly generate revenue. The managers of cost centers have the authority to incur cost. They are evaluated on their ability to control cost. Cost centers are usually either production departments or service departments. Production departments participate directly in making the product, whereas service departments provide only support services. A profit center incurs cost and expenses and also generates revenue. Managers of profit centers are judged on the profitability of their centers. Examples of profit centers include the individual departments of a retail store, such as clothing, furniture, and jewelry. Like a profit center, an investment center incurs costs and expenses and generates revenue. In addition, an investment center has control over decisions regarding the assets available for use. Investment center managers are evaluated on both the profitability of the center as well as the rate of return earned on the funds invested. Investment centers are often associated with subsidiary companies. Investment center managers control or significantly influence investment decisions related to such matters as plant expansion and entry into new market areas. This slide does a great job of summarizing the three types of responsibility centers. A cost center will incur cost, whereas a profit center will incur cost as well as generate revenue. And then finally, an investment center will incur cost, generate revenue, but also has control over decisions regarding the assets available for use. The evaluation of a manager's performance for a cost center is based on his or her ability to meet budgeted goals for controllable cost. Responsibility reports for cost centers compare actual controllable costs with flexible budget data. This is a budget report for the finishing department of Fox Company for the month of January. In this month, 9,000 hours are worked. The budget data are based on the flexible budget for 9,000 hours and the actual cost that has been incurred. The difference between the budget and the actual results in a difference or a variance, and it can be either favorable or unfavorable. This is a responsibility report which includes only controllable cost. No distinction is made between variable and fixed cost. This report is adapted from the flexible budget report for Fox Company in the previous slide. It assumes that the finishing department manager is able to control all the manufacturing overhead costs except depreciation, property tax, and his own monthly salary of $6,000. The remaining $4,000 of supervision costs are controllable by the manager and included in this report. To evaluate the performance of a profit center manager, upper management needs detailed information about both controllable revenues and controllable costs. The operating revenue earned by a profit center, such as sales, are controllable by the manager. All variable costs and expenses incurred by the center are also controllable by the manager because they vary with sales. However, to determine the controllability of fixed cost, it is necessary to distinguish between direct and indirect fixed cost. A profit center may have both direct and indirect fixed cost. Direct fixed cost relate specifically to one center and are incurred for the sole benefit of that center. Since these fixed costs can be traced directly to a center, they are also called traceable costs. Most direct fixed costs are controllable by the profit center manager. Indirect fixed costs pertain to a company's overall operating activities and are incurred for the benefit of more than one profit center. Management allocates indirect fixed cost to profit centers on some type of equitable basis. For example, property taxes on a building occupied by more than one center may be allocated on the basis of floor space used by each center. Because these fixed costs apply to more than one center, they are also called common costs. Most indirect fixed costs are not controllable by the profit center manager. The responsibility report for a profit center shows budgeted and actual controllable revenues and costs. The report is prepared using the CVP income statement. Controllable fixed costs are deducted from contribution margin. The excess of contribution margin over controllable fixed cost is identified as controllable margin. Non-controllable fixed costs are not reported. This is a responsibility report for the manager of the Marine Division, which is a profit center. Controllable margin is considered to be the best measure of the manager's performance in controlling both revenues and cost. This report shows that the manager's performance was below budgeted expectations by $36,000 or 10%. Note that the report does not show the Marine Division's non-controllable fixed cost of $60,000. These costs would not be included in a report on the profitability of the profit center. At this point, just prepare Part A, a responsibility report for the Sports Equipment Division, which is a profit center. When you are preparing the responsibility report, you need to deduct your variable costs from your sales to arrive at contribution margin. Then you will deduct only your controllable fixed cost from your contribution margin to show your controllable margin. You do not report non-controllable fixed cost on this report.